Why Stocks Go Up and Down by William Pike and Patrick Gregory. This is a book summary. Have you ever stared at a stock chart, watching prices rise and fall, and wondered why? What makes stocks go up and down? Is it all just a game of luck, or is there a method to the madness? Imagine this. It's late at night, and you're sitting at your desk, eyes glued to your screen as red and green candles dance across the chart. You sip your coffee, trying to make sense of it all. One moment, a stock is soaring, and the next, it's crashing down. Headlines scream about inflation, earnings reports, and interest rates, each claiming to hold the key. But deep down, you can't help but think, is there something you're missing? Is there a hidden logic to these wild swings, a pattern that only the pros can see? Well, you're not alone. Understanding what really moves stock prices is one of the most sought-after secrets in the world of investing. And today, we're cracking that code with the help of Why Stocks Go Up and Down by William Pike and Patrick Gregory. This isn't just another investing book filled with vague advice about buying low and selling high. No, this book is different. It's like having a seasoned Wall Street analyst sitting next to you, breaking down the financial statements, balance sheets, and valuation ratios that the pros use to separate winners from losers. Pike and Gregory don't just tell you what moves stocks, they show you how it happens, weaving together lessons on corporate finance, bonds, preferred stocks, and even the often overlooked world of convertible securities. They walk us through the journey of Mr. Jones and his mousetrap business. A story so simple, yet so brilliantly constructed that it makes the most complex financial concepts feel like common sense. You see, the real magic of this book isn't just the knowledge it offers. It's the way it tells the story of investing itself. The risks, the rewards, and the brutal reality that not all businesses survive. It's about understanding why some stocks explode in value while others fizzle out, why some bonds soar while others sink, and how investor sentiment can turn a solid company into a sinking ship overnight. So, grab a coffee, sit back, and let's decode the mystery behind the markets. By the end of this journey, you won't just know why stocks go up and down. You'll see the whole story behind the numbers, the drama behind the charts, and maybe even discover a new way to look at the market. Chapter 1. The Foundation. Our story begins with a man named Mr. Jones and his dream of building a better mousetrap. It's a brilliant setup to teach us the essentials of business finance. Through the eyes of a man with a vision and a toolkit, when Mr. Jones deposits $100 into his new business account, it's not just about the money. It's the spark that ignites an entire financial journey. In that moment, we get a front-row seat to the birth of a business. From the raw optimism of a sole proprietorship to the meticulous construction of financial statements. But here's where it gets interesting. That $100 doesn't just sit in the account, it transforms. The authors, William Pike and Patrick Gregory, use this simple, almost homespun business to unravel complex financial concepts with a clarity that feels like sitting down with a mentor. As Mr. Jones buys supplies and sells his first traps, we learn the difference between current and long-term assets, why liabilities are more than just debt, and how owner's equity captures the essence of what a business is truly worth. It's like watching a play unfold, where every dollar has a role, and every transaction is a twist in the plot. The balance sheet becomes a living document. Assets on the left, liabilities and owner's equity on the right, always balancing, always reflecting the heartbeat of the business. We start to see that financial statements aren't just columns of numbers. They are a narrative, a way of capturing the rise and fall of a company's fortunes. And then comes the income statement, turning the spotlight on profits and losses. When Mr. Jones sells his first batch of traps, we see revenue appear on the stage, followed by the cost of goods sold, leaving behind the star of the show, net profit. This isn't just accounting, it's storytelling, with each expense and sale a chapter in the larger tale of Mr. Jones's dream. Here's the kicker. The authors use this humble business to explore some of the most misunderstood aspects of finance. Take retained earnings, for instance, profits that aren't paid out as dividends but are reinvested into the business. It's money that could be in Mr. Jones's pocket, but instead becomes the fuel for future growth. We see firsthand why investors care about more than just today's profits. They want to know if a business can grow, if it can build value over time. And that's the secret. Stock prices are more than just numbers. They're a reflection of a company's financial health and its potential to grow. When investors buy shares, they're not just buying a piece of paper. They're buying a piece of that story, a belief in where the company is heading. Through Mr. Jones, we begin to understand why stocks go up and down. It's not just earnings, not just cash flow, it's the story behind the numbers, the dream of building something bigger. So, if you've ever looked at a stock chart and wondered what makes those lines move, keep watching. The journey of Mr. Jones is just getting started, and the lessons are about to get even deeper. Chapter 2: The Power of Ownership. Now let's talk ownership. Mr. Jones has a problem. A good problem, but a problem nonetheless. His mousetraps are selling faster than he can make them, and his garage is starting to look more like a factory. The dream is growing, but so are the bills. He needs more money to expand, to buy more materials, maybe even to build a small factory. But there's a catch. His bank account is running low. And the bank isn't exactly excited about loaning money to a guy building mousetraps in his garage. So, what does Mr. Jones do? He decides to sell shares, pieces of ownership in his company, to his friends. Now, this part of the book brilliantly explains how stocks represent ownership in a company and why investors buy them. It's not just for the hope of dividends. That's just the cherry on top. No, investors are in it for the potential increase in value, the dream that one day those shares will be worth a lot more. But wait, there's a twist. Ownership isn't just about how much you own. It's about control. Mr. Jones manages to keep 60% of the shares, giving away just 40% to his friends. And just like that, he keeps control of the company. With 60% of the shares, Mr. Jones calls the shots. He decides what to do with profits, whether to expand or hold back, and even who sits on the board of directors. This part of the book is a masterclass in understanding why controlling stakes are so powerful. It's not about being the richest shareholder. It's about having the final say. And it gets better. The book dives into the psychology of ownership. For Mr. Jones' friends, buying shares isn't just an investment. It's buying into Mr. Jones himself, his vision, his ability to turn wood and metal into a thriving business. This is the part that most investing books miss. Stocks aren't just financial instruments. They're tiny pieces of a story. And investors want to believe that story will end well. Then there's the fascinating world of stock classes. The book explains how some companies issue different classes of stock, Class A, Class B, each with different voting rights. In some companies, one class might get 10 votes per share, while another gets just one. It's a way for founders to raise money without giving up control, like selling the car but keeping the keys. Mr. Jones doesn't need that yet, but the seed is planted. And here's the part that really makes you think. By selling shares, Mr. Jones isn't just raising money. He's bringing in partners, people who now have a vested interest in seeing him succeed. That $75 each friend invests isn't just cash. It's a vote of confidence, a statement that they believe in the dream of a better mousetrap. In the world of investing, confidence is worth its weight in gold. So the next time you see a stock price rise, think about Mr. Jones and his mousetraps. It's not just about earnings or assets. It's about ownership, control, and the power of a great story. And as we'll see, the stakes are about to get even higher for Mr. Jones and his investors. Chapter 3: Borrowing Money and the Debt Trap. Of course, Mr. Jones doesn't stop at equity. Selling shares might have brought in some cash, but it also came with a cost, giving away pieces of his company. And as his mousetrap business grows, so do his ambitions. He's got plans, bigger orders, better tools, maybe even a proper factory instead of his cluttered garage. But those dreams come with a price tag that far exceeds what he's raised from his friends. So, what does he do? He heads to the bank, not for another deposit, but for a loan. And just like that, we're introduced to the world of bonds, a world where money isn't raised by selling ownership, but by borrowing it. Here's where things get juicy. The authors, William Pike and Patrick Gregory, break down bonds not as mysterious financial instruments, but as simple loans with a twist, fixed returns. Unlike stocks, which rise and fall with every new headline or earnings report, bonds offer a promise, an interest payment like clockwork, month after month. In the world of investing, that kind of predictability can feel like a warm blanket on a cold night. But borrowing comes with a dark side, interest payments, which can crush profits if things go south. Mr. Jones learns this the hard way when the bank agrees to lend him $50, but with a catch, a high interest rate to offset the risk. Suddenly, he's not just making mousetraps, he's making them for the bank, with each sale eaten up by interest payments. It's a harsh lesson in leverage. Borrowed money can amplify returns, but it can also turn a profitable business into a debt-ridden disaster. The book does a brilliant job of showing this delicate dance between equity and debt. Raise money by selling shares, and you dilute your control, your say in what the company does next. Raise money by borrowing, and you keep control, but only if you can keep up with those relentless interest payments. It's like watching Mr. Jones walk a financial tightrope, with equity pulling one way and debt the other. One false step, and the whole thing comes crashing down. And then there's the fascinating world of bond ratings and risk, where Mr. Jones learns that some bonds are rated like high school report cards. AAA for the safest, junk for the riskiest. It's a game changer. Those ratings tell investors how likely they are to get their money back. And for Mr. Jones, they determine just how much interest he has to pay to borrow the cash he needs. The lower the rating, the higher the interest. And suddenly, Mr. Jones is learning that debt doesn't just come with a price, it comes with a reputation. But it's not all doom and gloom. The author shows us that debt, when used wisely, can be a powerful tool. Take bonds with conversion features, for instance, debt that can turn into equity if things go well. For Mr. Jones, this could mean borrowing money today without drowning in interest payments tomorrow. It's a reminder that in the world of finance, flexibility can be just as valuable as cash. And here's the real takeaway. Through Mr. Jones' journey, we learned that finance isn't just about numbers. It's about choices. Every dollar borrowed is a trade-off between risk and control, between today's dreams and tomorrow's realities. And for Mr. Jones, the stakes are only getting higher. So stick around, because the next chapter isn't just about finance, it's about survival. Chapter 4. Why stocks really move. This is the million-dollar question, the one that keeps investors up at night, staring at charts and trying to decode the patterns behind the madness. And this is where the book Why Stocks Go Up and Down truly shines. It cuts through the noise and hype of the financial world to reveal the real drivers behind stock prices. It's not just earnings or news, though they play a part, it's something deeper, something more psychological. Investor perception. Picture this. Mr. Jones's mousetrap business is booming. Sales are through the roof, profits are climbing, and every new order seems bigger than the last. Investors see the numbers and start buying up shares, not just because of the profits he's making now, but because they believe those profits will keep coming. In the world of investing, it's not just about what a company earns, it's about what people think it will earn in the future. Stocks rise and fall, not just on today's numbers, but on tomorrow's hopes and fears. That's where valuation ratios come in, the secret weapons that investors use to peek beneath the surface. The book emphasizes these ratios: price to earnings, PE, price to sales, and a whole host of others, as the lenses through which investors see a stock. Understanding these ratios is like having X-ray vision into the stock market. They strip away the headlines and hype, letting investors see the underlying health of a business. Take the PE ratio, for example. On the surface, it's just a simple calculation: price per share divided by earnings per share. But in reality, it's so much more. A high PE ratio can mean investors have high hopes for future growth, while a low PE might signal doubts or even a hidden opportunity. It's like reading the room at a party, understanding the mood and what might happen next. But the book doesn't stop there. It pulls back the curtain on other ratios that reveal even more. There's the price-to-sales ratio, which helps investors judge if a company's sales justify its stock price, especially useful when earnings are thin. Or the price-to-book ratio, which tells us if a stock is trading for more than the actual value of the company's assets. For Mr. Jones, these ratios are lifelines, ways to show investors that his company is worth the price, that his mousetrap empire isn't just profitable today, but will be even bigger tomorrow. And then comes the concept of market sentiment, the emotional side of investing that no ratio can fully capture. Even the best valuation ratios can't predict when investors will suddenly panic or rush into a stock out of sheer enthusiasm. When a competitor enters the market or a new report questions the safety of Mr. Jones's mousetraps, it's not just about the numbers anymore. It's about fear and greed, two forces that have sunk empires and made fortunes. The authors do a brilliant job of weaving this all together, showing how the logical side of investing, valuation ratios, and financial statements interacts with the psychological side, investor sentiment, and perception. It's a reminder that the stock market isn't just a place where money is made or lost. It's a stage where human nature plays out in real time, where every buy and sell order tells a story of belief, doubt, and the endless quest for profit. So, the next time you see a stock shoot up or crash down, remember, it's not just about earnings reports or economic forecasts. It's about what investors believe those reports mean. Chapter 5: The Hidden World of Bonds. The quieter, less flashy cousins of stocks. While stocks grab all the headlines with their wild price swings and tales of overnight fortunes, bonds tend to linger in the background, more reserved and predictable. But don't underestimate them. In Why Stocks Go Up and Down, William Pike and Patrick Gregory pull back the curtain on bonds, revealing them to be powerful players in the financial world. Players that can influence stock prices in ways most investors never see coming. Imagine bonds as the gravity of the financial universe, an invisible force that pulls on everything else, from stocks to real estate. Rising interest rates make bonds more attractive, like a planet growing denser and pulling nearby objects into its orbit. When that happens, money flows out of stocks and into bonds, causing stock prices to drop. Investors aren't emotional here. They're practical. If bonds offer a safer return, why gamble on stocks? It's a trade-off between risk and reward. And in times of uncertainty, safety often wins. But here's where things get interesting. The book doesn't just explain bonds in dry technical terms. It brings them to life through examples and stories that make you feel like you're right there with Mr. Jones, navigating the complex world of finance. For Mr. Jones, borrowing money through bonds seems like a smart move. Fixed interest payments, no dilution of ownership. But then the Federal Reserve raises interest rates, and suddenly, the interest payments on his bonds start looking steep. Investors notice, and before Mr. Jones can adjust his spreadsheets, the price of his company's stock starts to dip. The book dives into different types of bonds, government bonds, corporate bonds, even the mysterious world of convertible bonds, which can transform into stocks under certain conditions. It's like watching a spy movie where every character has a secret identity. Take convertible bonds, for example. On the surface, they're just loans. But when the company's stock price rises high enough, they can convert into shares, turning debt into equity, and adding a whole new layer of complexity. For Mr. Jones, that's both an opportunity and a risk. It's a reminder that bonds aren't just about safety, they're about strategy. Then there's the yield curve, which the authors describe as the stock market's crystal ball. When short-term bond yields rise above long-term ones, a scenario known as an inverted yield curve, it's often a harbinger of recession. For investors, this is like seeing storm clouds on the horizon. They start pulling money out of stocks and parking it in bonds, seeking shelter from the coming storm. Understanding the yield curve, the book argues, is essential for any investor who wants to see beyond today's headlines. It's not just about knowing what's happening. It's about seeing what's next. And let's not forget bond ratings, the financial world's equivalent of restaurant reviews. AAA bonds are like 5-star bistros, reliable and safe. Junk bonds? They're more like roadside diners with questionable hygiene, risky but with the potential for a big payoff. When Mr. Jones decides to issue bonds, he learns quickly that the rating determines how much interest he has to offer. A lower rating means higher interest payments, and suddenly, the gravity of bonds starts to pull harder on his stock price, making it sink under the weight of those payments. So, the next time someone tells you bonds are boring, remember this. Without them, the financial system wouldn't just be different, it might not work at all. Bonds are the anchors that keep the stock market from drifting too far, too fast. They are the balance between risk and safety, the counterweight to the stock market's exuberance. Because if you really want to understand why stocks go up and down, you can't ignore bonds. In fact, they might just be the key to it all. Chapter 6. Cash flow, the lifeblood. In fact, it's the lifeblood of every business, the difference between staying afloat and sinking without a trace. The book, pulling no punches in showing just how dangerous it can be to focus solely on earnings. A company can boast record profits on paper and still go bankrupt if it runs out of cash to pay its bills. It's a sobering reminder that in the world of finance, what you see isn't always what you get. And who better to teach us this lesson than Mr. Jones and his mousetrap empire? As his business grows, so do the demands on his cash. Supplies have to be bought, employees paid, and the bank loan needs servicing, whether he sold any traps that month or not. On paper, the income statement might look great, showing growing profits quarter after quarter. But the cash flow statement? That's where the real story is told. It reveals a troubling truth. Cash is draining faster than it's coming in. Mr. Jones has profit, but no cash. And suddenly, the whole business is teetering on the edge. The book takes us deep into the mechanics of cash flow, breaking down the difference between operating cash flow, investing cash flow, and financing cash flow. It's like getting a backstage pass to see how the financials really work. When Mr. Jones makes a big purchase, say a new machine to double production, it doesn't show up as an expense on the income statement right away. But the cash, that's gone instantly. It's a brutal lesson in timing. Even a profitable business can run aground if it doesn't have the cash to keep the lights on. Earnings are like the pretty pictures in a restaurant menu, appealing but not always accurate. Cash flow is what's actually happening in the kitchen, the reality behind the scenes. The book drives home this point by explaining how clever accounting tricks, like delaying expenses or recognizing revenue early, can make earnings look better than they are. But cash flow, that's much harder to fake. When Mr. Jones gets a big order but has to wait 90 days for payment, his earnings might look great, but his cash flow suffers. Bills have to be paid now, not 3 months from now. This part of the book is a masterclass in reading financial statements, showing how cash flow can reveal risks that earnings alone can't. When Mr. Jones extends generous credit terms to his customers, his sales skyrocket. But the cash flow statement reveals the hidden cost. Cash dries up. It's a powerful reminder that cash flow doesn't just measure how much money comes in. It shows how fast it comes in. And in the world of business, speed can mean survival. The authors also dig into free cash flow, the cash left over after all expenses and investments, arguably the most important number in all of finance. It's the money that can be used to pay dividends, buy back shares, or reinvest in the business. For Mr. Jones, free cash flow is the difference between growing his business and being strangled by debt. Investors love it for the same reason. It's a measure of how much cash a company can generate without borrowing more. Companies with strong cash flow can seize opportunities, whether it's acquiring a competitor, launching a new product, or riding out a downturn. When a recession hits and credit dries up, it's the companies with cash that survive. For Mr. Jones, a strong cash flow means freedom, the ability to build his business without constantly worrying about running out of money. In the end, it's cash, not earnings, that determines if a business can grow, survive, or collapse. Chapter 7. The real reason stocks go up and down. The authors roll up their sleeves and show us how to dissect a publicly traded company, using everything we've learned so far. Financial statements, cash flow, bonds, and valuation ratios, to understand why its stock moves the way it does. For example, a rising PE ratio might not just signal that a stock is getting expensive, It could be a sign that investors are expecting big things in the future. Stock prices are all about expectations. Current profits matter, but they are just one part of the story. What really moves stock prices is what investors believe will happen next. This is where the book exposes the stock market's dirty little secret. It's not a numbers game, it's a psychological game. The entire system runs on perception and reality, and often, perception wins. If enough investors believe a company is the next big thing, the stock price rises, sometimes far above what the financials might justify. But the book doesn't stop at investor sentiment. It goes deeper, exploring how professional analysts build financial models to project future earnings. This means estimating sales for its best-selling products, adjusting for potential competition, and factoring in research and development costs. The authors break down these models step by step, revealing how tiny changes in assumptions, like the growth rate or profit margins, can lead to massive swings in the target stock price. And then there's the impact of macroeconomic factors: interest rates, inflation, and market sentiment. When the Federal Reserve signals an interest rate hike, for example, it's like a gust of wind shifting the entire stock market. Bonds suddenly look more attractive, pulling money out of stocks and causing prices to dip. Investing isn't about knowing what a company did last quarter. It's about imagining what it might do in the next 5 years. Stock prices are the sum of all those expectations, hopes, fears, dreams, and sometimes even delusions. The real skill isn't just analyzing numbers. It's understanding the story those numbers are telling, and how that story might change. Imagine walking into a casino, not as a tourist, but as a card shark who knows the odds inside and out. That's the power of mastering the basics in why stocks go up and down. You're no longer just a spectator in a stock market casino. You're a player, someone who can look beyond the flashing lights and see the mechanics underneath. You're the one who can tell when a stock's price surge is just hype, or when it's backed by real, sustainable growth. It's about transforming the way you see the market, from a chaotic whirlwind of numbers to a strategic game of risk and reward. Investors don't buy stocks, they buy stories, and the better you understand those stories, the better your chances of success. And that's what makes this book different. It's not about telling you what stocks to buy or when to sell. It's about teaching you how to think like an investor. So if you enjoyed this breakdown, smash that like button, subscribe for more, and drop a comment on which investing books you want us to tackle next, because this is just the beginning. The stock market might be unpredictable, but the fundamentals are timeless. Until then, keep investing wisely, keep learning, and above all, keep questioning why stocks go up and down.